Welcome, everybody. I am pleased to be joined by Logan from Forecastr once again for a brand new series, a series that Forecastr is introducing as well as part of our new series of Scale. So this is our second event in Scale. Scale is kicking off we've already, the idea has been validated. The product, or the company at least, has launched. The initial capital, whether it's your own, your friends and families, or something like that, to just get you to the first milestone is done. You've grown something of a business, but now we're talking about scale. And scale can be a lot of different things. It could be anywhere scaling all the way to an M&A and an exit. It can be pouring fuel on the fire for a product market fit company that's really got to scale up to customers. And in this very webinar, and probably in a lot of them, about fundraising. Often you need to fundraise to scale, and you need to fundraise at a level bigger than a friends and family round. So Logan's here to present a three-part series they're calling The Art of War. Not that raising from investors is like physical combat, although I do have a friend with a book coming out who is a notable founder called Founder versus Investor. So it does take sides like that sometimes, but really putting together full strategies and actually being strategic about it rather than just running out and being like, I'll just ask for money from whoever I can. It's like you will grow much further. If you've been to any of our webinars in the past, you will know a bit of proactivity, a bit of education up front can save you tons of welts when you really get hit with reality of the difficulties of fundraising and starting a startup. That being said, Logan's going to run us through this. This is the first time we did it, so we're probably going to make it conversational. This will probably be a little bit more casual. Hopefully that'll be a fun and good thing. At least I know Logan and I have a good time. As always, we're recording this. Please, the chat should be open, so throw your startup name and your location, where you're coming from. Any questions in the chat, the Q&A. If you really want an answer to a question, use the Q&A, because that gives us a nice bolded list, and sometimes the chat scales away. But I'll surface up any ones if they make sense while we're running. And other than that, Logan, I'll hand it over to you.
Awesome. Well, I will go ahead and start sharing my screen, and I will take us through some slides here. So first of all, thank you everybody for coming. If you've been to any of these webinars before, like Ryan said, this is the first time that we've ever presented this new series to Gus. And actually, I will address on the front end, this is, I think, my second time ever presenting this. So if it seems a little clunky, that's why I'm out of practice on this particular one. But don't worry, I've got some notes. I'll make sure that I hit everything. It's good content. So I want to make sure that you all get everything that we have to offer here. So the ones that we've done before have been more lenient on, or leaning more towards, financial modeling expertise, finance expertise. This one kind of intersects with Ryan and I's expertise. So I would love for Ryan to jump in and share his thoughts as well. We'll keep it light. We'll keep it conversational. Keep that Q&A active too. If anybody has a good question, we'll stop. We'll talk about it. We'll make sure that we get all the questions addressed. Another cool thing. So I'm a big fan of the fundraising sessions that Gus puts on with David Rose, their founder. One of the cool things about that is that he is a very, very active, one of the most active angel investors. And he's got a very investor-oriented talk that he gives about fundraising. And it's very, very valuable. I highly recommend you checking it out if you haven't. Ours is going to be a slightly different perspective because I'm a founder. My co-founder and I have raised about $10 million for Forecastr so far. So we are coming from the other end of the table. We are out there, we're grinding, we're trying to raise money. So we're going to give you our perspective on the process and how we like to think about it, just given all of our experience running a company and advising companies prior to starting our own company. So hopefully you find it valuable. There's a lot of fun putting this together, and I think that there's a lot of good stuff in here. The reason that we called the first iteration of this, Sharpening the Axe, it is actually a quote from Abraham Lincoln that I really, really like to use. He said, if I have 6 hours to chop down a cherry tree, he would spend the first hour sharpening the axe, right? So it's really the power of preparation. It's saying that if you are going to tackle a massive, massive thing like fundraising, is a very, very large undertaking, you have to make sure that you're prepared. If you go and try to chop down a tree with a dull axe, it is going to be very, very, very difficult. If you go out and try to fundraise not being prepared, it is going to be very, very, very difficult. So today we're going to be talking all about how to make sure that you're prepared, how to make sure that that axe is nice and sharp, so that you can get that tree chopped down. Just give you a little bit about me. So Steven on the slide, he's obviously not going to be here. Like I said, I'm Logan Burchett. I'm co-founder, chief operating officer over here at Forecastr. My background has been in finance. I was a fractional CFO for a number of years before I went out and started my own company. I helped companies through the fundraising process. Before that, it was kind of like I got to see others and see what worked and what didn't work before I jumped in and took over the process for myself for my own company. As I mentioned, Forecastr's raised about $10 million. And we've grown quite a bit because of, in no small part, to that investment. Or we're up around $2 million of annual recurring revenue, over 30 employees. Yeah, it's been really cool to grow a company. If you're not familiar with Forecastr, so the way that I like to explain what Forecastr is kind of through the lens of larger companies that maybe you're more familiar with. So if you're going to go and buy stock in a company, or if you're looking at larger middle market companies, and you look at the organizational structures of those companies, you're going to find that they all have one department in common. It's called FP&A, which stands for Financial Planning and Analysis. So the entire purpose of that department is to take financial data that comes from accounting and then square it with all the other metrics that they track, project it going forward, and use that data to make really strong financial decisions. It's something that pretty much every major company has. It's a very, very important part of a business whenever you reach a certain level of maturity. And people will spend millions and millions of dollars per year to stand up these business structures, right? So people will hire, these larger companies will have CFOs, they'll have teams of analysts, they'll have teams of accountants that all work really, really hard to put these models together because they are so valuable. Now, if you're a startup, if you're a smaller business, you don't have the budgets to do this, right? It is very intensive. It's very time consuming. It requires a lot of technical expertise. So you can't get the benefits of a well-formed FP&A department. That's really where Forecastr comes in. So what we have done is we've taken what is the heart and soul of FP&A, which is the financial model, and we built software around it so that you don't have to be super technical and you don't have to have an Excel degree in order to stand this up. So we'll give you access to our world-class technology, and we will pair you up with one of our financial analysts that will build a custom financial model for you, and they will stick with you every step of the way to make sure that you get a really deep and detailed understanding of the financials of your business and use it to make really strong financial decisions and set yourself up for success. So if you're interested in learning more about Forecastr, we would certainly be interested in chatting with you. Jimmy, who is on our team right now, is going to drop a link in the chat to get in touch with us, and then we will show you what we're made of. We'll show you what we got. To run you through a really quick agenda. So we're going to talk about the different resources that you need in order to go out and raise money. We're going to talk about, how you build trust and how you inspire confidence with investors. We have top five tactic reviews, and then we're going to go through an example timeline, and then we're going to open it up for Q&A and make sure that we get all of your questions answered towards the end. So just to kick things off, what resources do we need to raise? So the first one, I think if I just hold the audience right now and said, what is the number one thing that you need to raise? If you're going to look at the resources, everybody's going to say pitch deck, right? It's a no. Everybody knows it. Like it's usually front and center. And if you Google fundraising, resources, the number one thing that's going to come up is your pitch deck, right? So what is a pitch deck? A pitch deck is essentially a visual aid for telling your story, right? You know what your story is. You know what you're trying to build. You know what the opportunity is. And it is your best effort and in a concise way, putting that together so that you can put it in front of an investor and tell your story. Now, when it comes to a pitch deck, we like to say generally less is more, right? You're telling a story and you need to think about that. That is kind of the mind frame that you need to be in, is you need to focus on what is the story, and then you need to create a visual aid to tell that story. One of the biggest mistakes that I've seen, and I'm sure that Ryan can relate to this, is getting a pitch deck that is basically a book, right? It is a 10 to 15 to 20 slide deck that is just your entire pitch in Word form. This is a massive, massive, massive mistake, right? Whenever you're pitching an investor, the pitch deck should be something that you are just using in order to help give kind of a visual aspect to the pitch. It should not be the pitch, right? The deck should not be the pitch. So less is more. Just focus on just helping that narrative, and you give the narrative in person, and don't make it too wordy. It's going to make it really, really hard to digest. And whenever you are pitching your business, a lot of times what's going to happen is the investor is going to be reading while you're pitching, right? You almost want the deck to be there in the background, just sitting there, and you don't even look at it necessarily, and you're just kind of pitching, and it's just kind of helping you tell the story. You're the show, the deck is not the show, right? You're the show, the deck is not the show. Another kind of reason that you want to focus on less content, right, is that you have to think of the purpose of the pitch deck, right? Why does the pitch deck exist? The pitch deck is not there to close the deal, right? Nobody has ever read a pitch deck and said, this is great, I need nothing else, I'm going to write you a check for $1 million, right? The pitch deck is not there to close the deal. The pitch deck is there to set the hook, right? You're not trying to win the whole deal on the first call. You're trying to sell the sizzle, and you are trying to build towards a longer term relationship. You're trying to get that next meeting. You're trying to further the process. You are not trying to get married on the first date, right? That is all the pitch deck is, right? It is meant to just pique the interest, understand the opportunity, understand the story, and then continue along the path. It is not meant to close the deal. And in the pitch deck, you really want to focus on the vision and execution. So generally, the way that we like to think about it is, do you have a large vision? So, AKA, is there a pot of gold at the end of the rainbow? Is this a big opportunity worth paying attention to? And are you the guy or girl that is going to be able to execute on this vision, right? You want to sell the vision and you want to prove the execution by showing what you've done and showing what you're going to do, right? So that is really the purpose of the pitch deck. Brian, curious to see if you have anything to add or any thoughts on top of that.
I mean, you're resonating great with the feedback we give, and I think even David did a pitch presentation. I love the "don't look at your deck" comment, because that really does separate, seasoned founders from people who are like, "Here's my PowerPoint presentation." Yeah. We say the exact same thing. I think the only thing to mention is I do think there's a place in the fundraising journey for higher resolution pitch decks. We often talk about them, and you'll probably get into this with like financial models too. I've seen the most commonly is like 3 basic pitch decks. There's like the one that you actually present to, which is very text light. It's very, 10-ish slides, the main slides that every investor is going to expect. It's basically your Gus profile, in, deck format. There's sometimes a takeaway, which is like, especially if you pitch in groups, like if you apply to groups of angels or something like that, it's not just an individual. Often you will leave a deck that might have a little bit more text. It's the same rough structure, but it's something that if an investor's interest was piqued, they can go back to and refresh their memory on like what the pitch was like. So it might be a little bit more, I would not say, 10 slides to 50 slides at all, but just enough text that you wouldn't be there explaining it. But I think, and I've heard Logan dig in on this before, is like, first contact, you never want to be absent from your pitch. If you could deliver a deck to an investor that they could evaluate absent you, like you're not pitching an investor at all. You're just sharing marketing materials that is not going to result in a check. You are selling yourself more than you're selling anything else, especially in the early days. But even at the scale stage, you want to be doing most of the pitching and keeping it light.
Yeah, 100%. So we actually have 2 versions of our decks. That's a really good point, Ryan. We have the "I'm going to pitch you" version, which is what we use 99% of the time. And then we have a version of the deck that can stand on its own. It is very text heavy. And to Ryan's point, that is a reference deck. That is something that after you've given the pitch, you can go back and you can look at. So very good distinction there. Okay, so I'm going to jump into the next resource that you're going to need, which is, of course, why Forecastr exists. You're going to need a financial model. So the way that I like to explain financial models, because this can be, they're widely misunderstood, documents. The pitch deck is a visual representation of your business. It's a visual narrative. It's a way to tell a story using visuals, right? The financial model is the opposite side of that coin. It's a mathematical narrative. They're the same narrative, right? They're the same story. It's the same vision. You have to make sure that they fit together and they're both telling the same thing. The pitch deck is going to tell it with pictures. The financial model is going to tell it with math, right? That's the distinction there. So whenever it comes to your financial model, you really want to focus on, making sure that you have a great financial model, but you really want to hone in on the revenue formula. Whenever it comes to evaluating businesses, investors are really, for obvious reasons, concerned about revenue. They want to understand how you're going to be growing. They want to understand the scalability of the business. So the revenue formula is that mathematical representation of how you're going to be driving revenue. So it's going to answer things like, how are you going to be acquiring customers? How are you going to be monetizing those customers? It's the most risky part of the business. And for most startups, that's the point where they fail, right? If you're growing like crazy and your revenue is going berserk, you are probably not going to fail. Somebody's going to give you money, right? So the revenue formula is going to be a really big, point that you're going to want to dig into. You want this to be a strategic narrative as well. So whenever you're presenting your financial model to the investors, focus on strategy. You don't necessarily have to dig deep into every individual metric because a financial model can be a very technical doc whenever done right. So there's a lot to go through and you can spend hours going through it if you really wanted to. My recommendation is whenever you're presenting the financials of your business, go high level and let the investor drag you into the details, right? If the investor wants to ask you a question about your cost to acquire customers or go deep into your unit economics or really understand at a very granular level a certain type of expense, they need to pull you in that direction. It is your job to start high level and let them steer the conversation. It's just like sales, right? You want the customer to kind of steer you where their pain points are so that you can address them. Same deal here. You're going to want to talk strategy high level and then let the investor steer the conversation towards where they want to go. We have an entire webinar about financial modeling for fundraising. One of the key points that I put is present, don't share, right? So this goes into what Ryan just said is, if I can help it, I don't want any of my fundraising documents to live on their own. I want to have a conversation with the investor. I want to show them how amazing our team is and our opportunity. And then I want to leave them with with the documents that I have so that they can dig in and then they can kind of satiate their needs. Same deal here with the financial model. You want to be there. You want to present the financial model. You don't want to send the financial model and say, here's my model, dig in, have fun, right? You don't want to do that. You want to use it as a hook to get the meeting. You want to get in front of the investor, and then you want to have a dialogue about that, answer their questions. So present, don't share, right? So that's the financial model. I'm going to go into the data room now. So this is the third key thing that we need to make sure that we have buttoned up. We have a template that you all can use if you're interested in the data room. I'm pretty sure does Gus have a data room product, Ryan? I can't remember.
Yes, we don't have a data room like here's a Dropbox, do whatever you want with it. But your Gus profile is like there's a private section of it, which when you apply to investor groups becomes what they call the deal room, and then eventually the data room for stuff like that. So that's freely available. If you have a Gus profile, you will see the two sides of it.
Awesome. Yep. So great resources for doing this. The general theme that I like to talk about whenever we're putting together a data room is I want to have pretty much all the information in there that anybody would need to make a decision. So, we have in there fat and juicy, right? We like to stuff it full in a very organized way. You don't want a bunch of disorganized files in there, but we like to keep things very organized, and everything that you could ever want to know as an investor, we like having all of that in there. So the reason for this is that whenever an investor decides to make a decision, they're going to go through what's known as due diligence, which means that they're going to ask for all this anyway, right? Due diligence is whenever they really do a big information request. They dig in through your metrics, they look at your financials, they look at your operating agreement, they look at all of the pertinent data for your business. And if they ask for that and you're not prepared, it's going to take a lot of time anyway. And 9 times out of 10, investors talk to founders that are not prepared and they just don't have it together. If you're the one that does, it's really, really going to mean a lot. The way that we used our data room whenever it came to fundraising is we would pitch an investor, we would tell them about our company, we would leave them with our data room after the pitch once they get to a certain point in the process, and they can dig in and see just how organized we are. It really, really helped us get our round done, and it really showed that we're responsible, we know how the game is played, and building confidence is a massive, massive point of fundraising. It's actually probably one of the biggest points of fundraising. So fat and juicy, make sure that you get all the information in there. A trick that we used, which is really, really cool, is every company, it doesn't matter who you are, every company has those questions that every investor asks that they think are gotcha questions, right? And you're getting the reps in, you know how to answer the questions, you've got it all kind of buttoned up the further along you get in the process. One trick to that, which I highly recommend, is putting together an investor FAQ, frequently asked questions, where you take all of those gotcha questions, open up a Word doc, and just give your perfect answer to those questions and put that at the bottom of your data room. So whenever they're going through and they're looking at it, they're probably like, why is your churn so high? Or why are your margins bad? Or why was this month so bad? Or what is the opportunity? Things like that. And you just have this, paragraph form, amazing answer to those questions. And it just works like magic, right? That was a tip that we got whenever we went through Techstars. And so it's the hardest questions about your business. You want to make sure that you get those answered and have them really, really buttoned up. And you thought through them very, very much on the front end so that they can be really strong answers.
I also think the process of going through that is essential to a startup, because I honestly feel like a lot of founders pitch their idea on the basis of, if somebody doesn't ask me this like gotcha question, like I will convince them to invest and thus the idea will succeed. That investment is the bridge between viability of the business or not. That is almost never the case. It's like the viability of the business determines whether or not you're going to get investment. So walking through some of those questions as a founding team, even as a solo founder, I think is essential to even just validating why you're raising a funding round, like, you know, where you're at in the business. So that's a great practice, Logan.
Yep. It's been very helpful for us. And then the last one is, you know, don't reinvent the wheel. There's a bunch of cool tools out there, Google Drive, Dropbox. You don't have to get too fancy. Gust, you know, you use the tools that are out there. You know, you don't have to go too crazy with it and try to reinvent the wheel here.
And I will plug Gust Launch here. If you're a Gust Launch company, if you're basically a US or expanding to the US company, Gust Launch is a great thing to start on. It starts with incorporation, which seems like an unsexy kind of thing, but the entire Gust Launch experience basically builds your corporate history. So there's probably 40% of your deal room, or maybe even 60% of your deal room, or your deal room, deal diligence, whatever you want to call it, is going to be like kind of boilerplate stuff, stock grant documentation, your certificate of incorporation, you know, contracts with all the people that you claimed were advisors or working for you in the company, you know, just, you know, being in good standing in the state of Delaware. It's not like hard stuff, but often founders find that it's tucked away in tons of different areas. So pulling together the data room takes a lot of time because you have to go, oh, let me get my latest version of whatever when we changed our authorized share count. If you're in the earlier stages, Gust Launch basically gives you a seamless corporate history with a one-click button to download all of that, you know, corporate history document, so you can drop it into whatever deal room. You're going to end up with multiple deal rooms probably in this day and age, because if you apply to a group on Gust, they're going to do their process through there. If you invite an individual investor that somebody you met at or whatever, they're probably going to get a Dropbox or a Google Drive or something like that. But it's nice to have that history all in one place.
Yeah, 100%. Gus makes it super easy. That's why we love working with them. So use the resources at your disposal. And
before we move on, we got a great question from Lunaid that I think both of us will opine on. Where can he get these gotcha questions?
You're going to talk to investors, talk to friendly investors first, and talk to mentors. And they will ask you questions about your business. And if they make you squirm in your chair, or if you feel like you don't have a good answer, then spend time with your team and potentially spend time with mentors and people like that to just think through, like, okay, what is a great answer for these questions, right? So in general, it's like, one of the things that I like to do whenever I think through the gotcha questions is like, what makes you nervous about your business, right? As the founder, you're probably the biggest stakeholder of your business. If not, you're one of the biggest stakeholders of your business. You know where the risks are. You know the things that you're like, oh man, like that's going to be really hard, or this is tough, or, you know, this I don't like, or whatever. So start with just what makes you nervous about the business. Go talk to smart people, give them your pitch, see the questions that they ask. If you feel like they're really hard questions you don't have a good answer for, you know, just really spend some time thinking through those. That's my opinion.
Yeah, I think the a little piece of context in there is no list out there for these questions because they're very business specific, you know, and startups are always innovating on their business models anyway. So, you know, as time goes by, they're always going to change. But it's like, for one startup, it's like, well, your churn's really high. How are you going to address that? For another startup, it's like your market's not big enough or something like that. It really varies based on industry, business approach, business model, founder experience, et cetera. But if you can't think of them yourself and they're not keeping you up at night, talking to smart people and trying to convince them, even if you're not trying to raise funds out of them, you're just trying to, you know, share your business idea with, like, I mean, you get in these networks and I get twice a week, somebody that I worked with at Gust or at a previous job or something like that texts me a random thing. Like, hey, I ran into this startup. They're thinking about this. Does that make sense to you? Or something like that. And those conversations can kind of come out. Talk to people, share your idea, get feedback. It's essential.
100%. Yeah. Cannot stress enough the power of community when it comes to fundraising or startups in general, specifically fundraising. The worst thing you can do for a company is think that you can sit in a room and do it all alone, right? Don't do that. Talk to smart people. And when the screws tighten, stuff will pop out and you'll see it. Right? Okay, so the fourth biggest material that you need whenever it comes to fundraising is going to be the investor pipeline, right? So like it or not, fundraising is a numbers game. You have to make sure that you get the top of the funnel. I can almost guarantee you that you need more leads than you think when it comes to fundraising. And you always want to have too many leads. You don't want to have too few leads. So I know that, you know, Ryan's talked about how they have really great content with HubSpot, and they talk about putting together an investor pipeline. We've got some really, really good content around that, which I highly encourage you check out. When it comes to fundraising, it's really hard to do this with a cold pipeline, and it's borderline impossible to do it with no pipeline at all. So if you're trying to build a pipeline of people that you need to know, start cold, start personal, or not cold, start personal, right? So talk to your friends and family, talk to friends of friends, put them into a big Google Sheet or a CRM like HubSpot or something like that. And you can use that small personal network to get warm leads into people that they know. So you can get, 2 to 3 names of investors that they know. And then, you try to build off of that. So if you meet with maybe a small group of friends, they know a few investors, you meet with those investors, you ask those investors, can you introduce me to 2 to 3 people? And then it kind of goes out in concentric circles like that. I think that you would be surprised. I think everybody would be surprised at how big their network actually is if they activate it in the right way. So you can start small and keep going out like that. And that's how you take a small network and you can build it into a larger network, right? Eventually, that's going to get exhausted. And if that happens, I would recommend that you look into a number of different resources. I think, Gust is a great resource whenever it comes to putting together leads for investors. That's a really, really great one. There's a lot of free ones out there. You can look at, Crunchbase, you can look at LinkedIn, things like that. Another trick is I like looking at investors that have invested in similar companies or complementary companies to your company. And you can just kind of like work the grapevine like that and try to get warm intros. I highly recommend at all times, whatever you can do, if you find somebody that you think would be a good investor for your company, do whatever you can to get a warm intro to that person. Cold intro should be a last resort, right? Cold intros work. Funny enough, that's how I got introduced to Gust. Was a cold outreach. I just emailed David Rose, and look at us now, years later. So they do work. It does work, but that should be a last resort. Always see if you can get a warm intro. Try to work your network. Most of the time, you'll have a connection of a connection of a connection that knows somebody, and you can work it if you're just really creative and if you're really smart about it. But the one takeaway I can give you, if you take nothing else from this slide, I would say build a pipeline and make it bigger than you think it should be. Don't run out of leads. If you run out of leads, the fundraise stalls. If the fundraise stalls, it's very, very hard to get it back on track. Okay.
I love that the warm intro, cold intro thing, because it is so hilariously, David is one of the few people in the world who responds to cold emails. And I'll say the difference is where you spend your time and how fast you're going to go, where a warm intro is a guaranteed acknowledgement and look from somebody, while a cold intro, you interject, I would say probably like a 90% inefficiency into it, where you're going to rely so much on serendipity, literally time of day, attitude of the individual at the given time, to even warrant a response, while a warm intro is almost always responded to. So an angel investor will review your pitch if, a friend of theirs said, hey, check this out, as opposed to literally just archiving it or never opening the email in the first place, even if they're not actively investing at the moment, even if you're completely in a different industry than they think you are, even if, their thesis is completely different, you'll at least get, the acknowledgement and maybe a piece of learning, which is like a warm intro to an investor who's never going to invest in you can still provide a lot of value in terms of like one of the questions that makes you squirm, or, a consideration on why, how a certain class of investors would view your venture. They can be fruitful conversations, even if they don't result in dollars.
Yeah, big time. The fifth and final one, and you might roll your eyes at this one a little bit because it's kind of squishy, but it is important. It is trust and confidence. You've got to bring that to the fundraising process, right? It is, like I said, one of the most important thing whenever it comes to fundraising is just building confidence in the process. Investors invest in founders they trust. And that is our main goal whenever it comes to fundraising is talking to investors and building that trust over time. Trust is not built in a day, right? That is why we want to devote a sufficient amount of time to the process to make sure that you're going to be building trust over time. And we're going to be talking about that here in a little bit further on in the presentation. So what does investor trust mean to you? So if we look at how that's built, in the first meeting, like we mentioned, we're not trying to close the deal. We're trying to lay a foundation. We're trying to lay a foundation of trust. So the first thing that you want to do whenever you talk to an investor is you want to get them to like you as a human. So you want to build a human connection. Investors, like I said, they invest in founders they trust, but they also invest in founders that they like, right? So do your research on an investor, show that you're prepared, be friendly, be likable, and be human. And you also you want them to believe in your vision. You want them to say, I like that person, they're on to something, right? If in the first meeting you meet with the founder and all you do is, or the founder, you meet with the investor and all you do is get them to like you as a human, they build some sort of a connection and just say, I think that they're on to something, then that's a good first meeting, right? And then you establish a touch point beyond that, and then you continue to work them through the process. Just don't jump in too much, too quick, too fast. And you also want to be able to show that you can execute well. So you want to know your stuff. You want to inspire some confidence in the meeting. You want to show that you're the person for the job. And you're going to reinforce this later on by proving that you're the person for the job and showing how you can execute through company updates and things like that. So we'll talk about that a little bit more in the presentation as well. There's an adage that I may butcher right now, but it is, what is it? Ask for money, get advice. Ask for advice, get money. So the ask for money, get advice, that is somebody jumping in on the first date and saying, write me a check for $100,000, right? That's not what we want to do here. We don't want to jump in and, do that immediately. What we want to do instead is we want to be friendly, be likable, treat it as a human connection. Over time, if they see what you're doing and if they like you as a person and if they know that you're fundraising and they have the means to do it, 9 times out of 10, they will end up investing, right? Okay, so now I want to, continue to talk about this theme that trust is built over time. It's not built in a 30-minute coffee meeting. So more meetings equals more trust, right? So what we want to do is we want to think through all of the different ways that we can continue to meet with the investors, right? Whenever you first kick off a raise, you don't want to spend a lot of time introducing yourself and things like that. You want them to have an idea of who you are before, they sit down and meet with you so that they, will decide whether or not they invest, right? So if you're trying to ask them for an investment, the first part of that meeting shouldn't be you introducing yourself. It should be something that they've already met you, they already know you. So, how do you build trust over time? So it all starts with that casual intro chat that we just talked about. It's just going to be like maybe a coffee meeting. It's just going to be you talking about your business, or you talking about what you want to do, or just getting to know them, building that real personal human connection, just getting them to like you, things like that. That's where it starts. Then you want to try to continue the conversation. You want to continue to build a closer relationship with them. This can be done through a number of things. So one of my favorites is if you have a co-founder, loop in your co-founder. Say, hey, this is great. It was awesome getting to know you. You're a really smart person. I would love, you to share some of your ideas with my co-founder, right? It'd be really great for him or her to meet you. And that's another way that you can get in front of them and continue to build a relationship, build confidence, things like that. Another one is that if you have a product, you can walk them through your product. Say, hey, you're obviously a really smart person. I would love to show you what we've been working on. Get your feedback on that, right? It's another great way to get in front of them again and have them give you some more ideas and just build more. And then another one is a tactical deep dive. So what I like to do here is, if you've done some research on the investor and you get a deeper sense of their background, and let's say the investor is an expert in sales, right? Let's say that they've led sales at a large company or something like that. Set aside some time and just be like, I really want to, dig into our sales process because I know that there's a lot that can be done with that. And I know that you did such great work at, Acme Corp or wherever you came from. Let's sit down and talk about that. If you don't mind, that would really, really help me out. What that shows is that you're coachable and you're not pitching them, right? They're helping you. And you got to think of the psychology of that. This investor is helping you build your company. They're helping you grow your company, right? So at that point, if they're invested and if they're helping and if they're learning about you and they're trusting you now and that trust is, like I said, built over time, they're going to be inclined to invest, right? If they see the company moving in the right direction, they're going to be inclined to invest. So the theme here is start with a casual intro chat just to get to know them, get on their radar, and then just find excuses to get on their calendar more. Find touch points to keep meeting with them, keep building trust over time. Use an investor pipeline, a CRM to show what you're doing and try to work them intentionally through the process. Right? It's a great way to just build trust with a large group of really smart investors. All right, so I want to talk now. So that's kind of like the meeting trust building tactics, but I want to talk now about kind of ongoing trust building tactics, right? So, your investors don't expect for you to have 100% bulletproof business, right? You don't want to seem like your business is doing unrealistically well, which is why on the slide we have be honest here. Whenever I say that, I don't mean just always act like your business is on fire and that things aren't going well and things like that, but just be honest with how your business is doing and be honest that, talking about where they can or can't help you, right? If your revenue isn't growing as fast as you'd like it to, let them know that, right? And see if they have any ideas or ways that they can help. If your churn rate's too high, let them know. It's a great way to enhance, use your community to help you build the business, right? So that's a big one. The other one is proof of execution. And this is, in my opinion, one of the biggest hacks, I should say, to fundraising is every month since we started the company, we have sent out what we call a monthly update, right? It is essentially just an update that we send to everybody that is in our community, be they investors or other founders or people that we just know. And it just talks about what happened in that month. Like, what did sales do? What are our biggest problems? Who did we hire? Like, what are the key metrics starting to look like? Things like that. We send it to everybody. I think at this point, we have like 5,000 people that get our monthly updates. We've started doing that the first month that we had the idea for Forecastr. And so every time that I meet with an investor, I'm always like, hey, can I get you on our monthly update? We'd love to get you on this list just so you can kind of be along for the ride. So if I don't touch the investor, if I don't talk to them in 6 months, they're still hearing from me every single month. They're still looking at what's going on in my business. They're still along for the ride. They're still getting emotionally bought in to what's going on. And I'm telling you, those monthly updates take an hour, maybe 2 hours a month to send out, and they are worth their weight in gold. Every time we talk to these investors, they're like, look, I read your updates every single month. Looks like things are going really, really well. Or, I just saw that this happened last month or that happened. It's just a great way to continue to get them to continue to be bought in for the company. So it's showing that you can execute. It's showing that you can be responsible, and it shows leadership, right? I am bringing in the right people into my company, and I'm giving them the correct amount of information. Shows leadership, shows that you can execute. And then finally, throughout the entire process, just keep being likable, keep being human. This isn't a transaction. If I were to sell my company to a big corporation, that can be a bit of a transaction. This is not that. This is early stage investing. This is a partnership. It's a marriage in some senses. Be likable, be human, don't be robotic. Treat it as a human connection.
I absolutely love that. I will, I have to preface, if I look a little strange, it's because a massive thunderstorm just rolled in and I'm watching my partner close down her deck and trying to provide guidance. So weird hand motions and laughing aside. And if I lose power in the next 10 minutes, that's exactly what it is. Logan, I think you'll be all right through it.
Yep.
But I did want to double down on that investor newsletter. I think that's actually an innovation in the space. I'm not going to give Forecastr the entire credit for doing it, but they were one of the most consistent people to do it. The entire reason we're even on this webinar right now is I'm assuming Logan or Steven cold emailed an investor looking for potential investment, got shuffled off to me, a C-level position in a company the investor was an investor or founder of, to be like, hey, these guys seem sharp. I'm not writing checks right now, or I'm not, really, it's not really my market, but like, check them out. They work with startups. So like, maybe there's something for us with them in some future if they're successful. They seem well put together. I think we talked for probably I got like 18 of these monthly newsletters over the next year and a half. It's like we would check in now and then. Logan and I and Steven would be there sometimes, and they were telling me about their startup journey, going to market in 3 months, took a little longer, hitting this, and took the classic startup story. But the thing is, you think about it, I was the CTO then of Gus, and 18 months later, like a partnership opportunity emerges because of that newsletter, and it goes so much quicker because I did not. If somebody would cold email and be like, "Hey, we have this forecasting startup." Geared towards startups and small businesses or growth-oriented businesses, random cold stranger, would you be willing to like do programming with us in your community? Like, no. Like maybe in 18 months or 2 years, or like if you're a household name or something like that. But I'd been receiving updates for 18 months, and I'm a startup person myself, and I saw the progress that was being made. I saw the setbacks, I saw the gains, I saw the professionalism, and I was just kind of part of the narrative. So saying yes to a small trial, we literally invited like 2,500 people when we normally invite tens of thousands to kinds of things like this. was like a no-brainer. I'm like, yeah, you know what? These guys are legit. They've been sending me updates. They're running a good shop. Let's try it out. And now we've been doing this for what, 2 years?
2 years. It's been great. It's been great.
Yeah.
And I call it a hack because it's so easy and it's anybody can do it. Anybody. I'm going to plug Paper Street right now. They're a great tool for doing that. This is what they do. They help you send these on a monthly basis. And Ryan's 100% right. It's not just for fundraising. It's for partnerships. It's for sales. It's for anything and everything that you can think of. So, I've said this a couple of times, but if you take one thing away from this webinar, it is, if you're not doing a monthly update, do a monthly update. I promise it'll be worth it. Right?
Yeah, I think this is actually a shift in company growth and fundraising. Now that the internet is so ubiquitous and communication chains are so ubiquitous across the world, I think we're even seeing this with crowdfunding. Like a lot of the crowdfunding sites are pitching themselves as like, some of your customers are going to be your best sales reps. Some of your early investors or, crowdsource kind of things, they're going to actually see through a different lens. It's almost like treat everybody like an investor. Like I wasn't an investor in Forecastr for that, but getting the investor updates was like, oh, you get an insight into the business, especially in the early days. And early, I think, would even go Series A and beyond with this kind of stuff. But I think it's a super cool change in this space.
Big time.
Rain is coming in.
No, you're good, man. All right, I'm going to step it up a little bit because we have 59 messages in the chat. I want to make sure that we get through the Q&A here. So I'm gonna speed through here just a little bit. But I do want to talk about our top 5 tactics when it comes to fundraising. So number one, I've already kind of hit on, but I'm going to hit on it again. Play the numbers game, right? You need more leads than you think you need. I absolutely promise you that you need more leads than you think you get. In our seed round, we got about a 10% close rate on the investors that we pitched. In this recent round that we just raised, it was a lot less than that. I think we pitched over 100 investors and we got 1 term sheet. So we got like a 1% conversion rate on that. You need more leads than you think. Do not run out of leads. If you run out of leads, I don't want to be so, I don't want to say your fundraise is dead if you run out of leads, but it could kill your fundraise if you run out of leads. Don't do that. Number 2 is going to be share the milestone that you want to hit with the round. So don't say, I want to raise $1 million to hire 15 people, and that buys us 18 months of runway. Instead, say you're raising $100,000. You're raising to get to $100,000 a monthly recurring revenue. It's kind of outcome oriented versus just this is what you're buying. That's kind of the way that we like to anchor it, is do this so that we can do this and achieve this, right? The other one is narrative first. So don't worry too much about the ordering of the slides or anything like that. Focus on the narrative, focus on the story. Fundraising is a storytelling game, so just make sure that the narrative is there. Everything else is just supporting the narrative, but that's the most important thing. Number 4, this is a big one, and Ryan's going to have opinions on this too. So the terms and the structure should be the second, should not be the number 1 focus, right? You don't want to optimize your round for terms. You don't want to optimize your round for valuation. We recommend not even going to market with terms. You want to optimize for the yes, and optimize for getting the round done, and then focus on the terms later. Once you get the yes and the right group of people and the right investors, work with them to set terms. But driving too hard on a certain valuation or a certain set of terms is one way that you can harm around. If somebody doesn't like your valuation or something like that, a good investors may be turned away, and it's just going to make your job harder. Fundraising's already hard. Don't make it harder than it already is. So we say put terms second. They're important, but they're not the most important thing. The most important thing is getting the round done. And then the last one is, again, I said it's a bunch. Be likable, be human, be interesting, just be human in this entire process. These are not robots. These are not big, scary people. They're other humans, and treat them as such. Right?
I will agree with you on the terms. Terms close the deal. They do not get the initial interest. And often terms can be a gotcha question that you don't even realize, where it's like, especially if you lead with it. If in your slide deck is, especially in the early conversations, as things metastasize and you maybe have a lead investor, you have warm things, this could definitely change. But in your first couple pitches, if you have a slide that's like, we're raising $500,000 at a $7 million pre-money valuation on a YC post-money safe, that is a huge signal to investors who live and breathe those kind of things. You have completely shifted how you're communicating your fundraising round, as opposed to getting interest, getting somebody excited about you and the idea and the promise and the opportunity. And sometimes some of the best investors will help you change and set better terms, or just make the terms that make sense for getting the deal done at the level that you need it to be. So I agree with that one.
Big time. Okay. So last is just going to be a real quick overview of a timeline, right? So if we're looking 12 to 16 or 12 to 6 months out, we really want to start the process. We really want to start it about a year out because trust building takes time. So you want to start meeting with investors. You want to start just those early conversations and just kind of planting those seeds and continue to talk to them. Get them on that monthly update list so that they're seeing 12 months of those updates and they're seeing your execution in the background. So they're just kind of running in real time. So it's just slowly reeling them in, slowly kind of getting them bought in on your company, right? And then once you're 6 to 3 months out, that's where you're going to really be focusing on sharpening the axe and getting all of your resources together. So that's the deck, the model, the data room, and the investor pipeline. You want to make sure that all of those are good. And I recommend specifically on, well, really on all of them, send those around to mentors and get them to give their thoughts on it. So send them your deck, close mentor, send them your deck, your model, your data room, your investor pipeline, and get them to like beat it up so that you can go and just do a bunch of rounds of iterations so that way, whenever you actually go and have the real conversations, they've been put the ringer and you're going to be in good shape there. And then once you're about 3 months out, that's where you're polishing the final drafts of the materials and you're scheduling your first wave of meetings. So we're actually going to talk more about strategies of setting waves in the next talk, where you're going to basically be kind of like having circles of meetings with different, types of investors and different, different ways that you talk to them. So we're going to talk about that in the second one. But you want to do this far enough out so that you can put density on the calendar. So ideally, whenever you start your fundraise, it's go time and you've got a ton of meetings just clustered right there, all at the very, very front end, so that you're going to get momentum in your round. You want them to, you want to be able to show that you're getting early wins and that your round is popping off really, really quick. To do that, you have to manufacture momentum. If you're trying to set a meeting a week on an investor's calendar, like a week out, you're going to bump up against the vacation time, out of office messages, things like that. Do it like 3 months out. Just make sure that you get that on the calendar. You want momentum here. It's really hard to get momentum whenever meetings are far apart. So that's where you're going to want to focus on 3 to 0 months out. And I'll end it here because I want to make sure that we get to all of the 66, questions I think we got in the chat.
We can get them.
Yeah, we'll do what we can. I'll leave you with, if you're interested in Forecastr, just a little bit about our pricing. As I mentioned, we're not just a financial model. We're a financial model with an analyst that's going to help you throughout the entire time that you're with us. So we have 3 different packages. We have an Essentials, a Growth, and a CFO. Essentials, we're going to give you a financial model. We're going to update it every quarter. We're going to advise you on it every quarter. And we're going to give you reporting specific to your investor base that you can send to all of your investors. That's going to help you fulfill your fiduciary duty and your legal obligation in some cases to those investors who require financials on a quarterly basis a lot of the time. Then the growth plan is that same deal, but monthly, and you get a dedicated operating report as well. That's going to help you run your business better, all the way up to fractional CFO services. And we've sold, I don't even know how many Gus customers at this point, but hundreds, and they've all come back very satisfied. So with that, I'm going to stop sharing my screen and we are going to dive into some questions.
All right. I'm going to go one that Jimmy nicely answered in the Q&A in the beginning of it, but this always comes up, and you were just talking about Forecastr's offering. What does a pre-revenue, pre-product company, what value, if any, can they get out of working with Forecastr?
Yep, that's a great question. And before I answer that, I forgot to mention a very important point of the pricing. Everybody on here gets a 25% discount off of those numbers that you just saw. Because you came from Gus, you get a 25% discount off of that. But to answer your question, it is, the financial model always is going to have value for your business, but the type of value that you see is going to change and evolve over time. So whenever you're really, really early on, a lot of the value of that is trying to understand the path of least resistance in getting to revenue, or just understanding what your metrics need to be for you to find success. So I've given this, I've told this story several times, I think, on Gus webinars, but it's a really important story, I think, that kind of shows the value of financial modeling. Whenever me and Steven first had the idea for Forecastr, we wanted to be a freemium product. So we thought, hey, we're going to charge $50 a month, or I think it was like $20 a month. 90% of the customers that use Forecastr are going to be free, and 10% are going to be paid, and they're going to pay us $20 a month. And when we modeled that out and we showed what we would have to, how many customers we would have to have in order to hit our targets for our investors and things like that, it was not going to be possible. Like it was something like 50,000 companies were going to have to use us in order for us to get where we wanted to go. And if you look at how many startups are in the US, it was like an insane market penetration that we'd have to achieve. So we pivoted because of our financial model before we sold a single dollar of revenue, or before we wrote a single line of code, or we talked to a single investor, right? We did the math, we put it in the model, and we realized this is a bad idea. So what did we do? We pivoted, we went the exact opposite. We said, no, we're not going to be super cheap. We're going to be still cheap, but we're going to pair up, we're going to lean into the service. We're going to give you an analyst. We're going to give you our software. We're going to charge you for it. And in that way, we can actually achieve what we want to achieve with a significantly smaller amount of startups. And it's worked out really, really well for us so far. So it's more of a decision-making tool on the front end. And then as you evolve, it becomes a reporting tool, and it helps reinforce decisions and help you make better decisions. So.
And accountability too. You can get ahead of, when you're putting your actuals in, you can get ahead of, decisions that you need to make, or, realities that have occurred.
Yep, big time.
Awesome. All right, I'm going to pull some from the Q&A. We had way back, Femi, who's been really active in chat, is asking about, so we can generalize this a little bit, but they're asking about the price to raise a first-time hardware plus subscription startup. So we can start maybe with a little bit of opining on that, but just in general, how do you think about what to raise, how much, and how to value your company?
Yeah, it's kind of a squishy thing. And yeah, Ryan, I'm curious to get your answer on this, but generally you've got your different rounds of funding, right? You have your pre-seed round, you have your seed round, you have your Series A round, and so on and so forth, Series B and whatever. The market has general bands in which they price these rounds, and general bands that is kind of acceptable for amounts of money that you should raise in these rounds. So if you're looking at a pre-seed round, it can be anywhere from 500,000 up to like $1 million. Seed round usually is between 1 to 3. Series A can be pretty much anything these days. So there are tight bands that, or not really tight, but I should say loose bands that the market typically likes to see in these types of rounds. That being said, my advice is just sit down and think through what you actually are going to need to run the company, the people that you need to hire, the things you need to buy, the things you need to pay for. Model that out for 24 months, right? 2 full years of runway. And if you're early, I would recommend doing that assuming 0 revenue. That's just my opinion, to be super safe. Do that, throw a 20% buffer on top of that, and round that to a number that kind of makes sense. Round it up to a number that makes sense. Just make sure that you raise enough money. Don't raise just the amount that you think you need. And then that's what you're going to use to go out and fundraise. Hopefully that's kind of within those bands. And it's not some crazy number like $10 million that you're trying to raise at a pre-seed. But that's a general, very high level approach to figuring out how much money you want to raise.
Yeah, we have the same answer. It's always back it up from, Logan talked about that milestone that you're communicating to investors. It's like, hey, we're going to raise this money to get to 100,000 MRR. We're going to raise this money to get to, landing this major deal, whatever it is, but back it up. And a financial model is so far, other than just like made up narrative storytelling, the only real concrete thing I've seen been able to back up how much we actually need, rather than just like, thumbing in the air saying, I don't know, 400 grand, that sounds like a nice even number. Femi did update his question, and he didn't mean price, he meant motivation. So I'll say one last thing on price, and I'm putting in the chat right now. We have a free tool that helps you figure out where you are in all the kind of like pre-seed to seed stage. Doesn't work for Series A. If you're in the millions and millions, like you're far beyond the stats that we collect. But run through that, and it will literally give you a band and likely sources of capital. It'll say, investors would, give you anywhere from 1 to 300,000 with check sizes this big from these different sources. It can be a big help. To really level set you in the early days. In terms of motives, which is what the updated question was, I'll answer this and throw it back to Logan. But I say this all the time, the motive to raise money for any kind of startup, whether you're hardware and subscription, whether you're a lifestyle brand, whether you're consumer packaged goods, is because you need it. Don't raise money if you don't need it. If you have a path to profitability or go to market or anything, that doesn't require investor money and doesn't require, I mean, look at all the axe sharpening work you're going to have to do. Look at the time frame that Logan just laid out. If you don't need to do any of that and you don't sell any of your company, you are in a much better position than the vast majority of companies out there. Like fundraising is, it's really bizarre because it is like a thing of last resort that has a massive amount of like industry and knowledge and resources and community around, but it really is only needed if you actually can't bridge the gap yourself or through your own mechanisms. There are some businesses that don't ever need angel investors or VC money. There are some businesses that raise a little bit from a person in your network, got it to the point where they could grow, some scale, some linearly, some exponentially, who knows. But really sit down and think hard about, do I need to just go out and source capital from these professional investors? Because you might not need to.
Yeah, that's a really good point, Ryan. And I'll say that like fundraising in some ways can be seen as kind of a sexy thing whenever you look at TechCrunch and you see the big round that just got done and the people that, raised it and all of that good stuff. If you don't need to raise that round, do not raise that round. If you can get to profitability without it, it's really kind of a personal preference. And I've often, as an entrepreneur, and I think a lot of us do this on some level, but I've always thought about, in a post Forecastr world, will I ever start a new company, right? If I sell the company or whatever, will I ever start a new one? I think the answer probably is yes, but I don't think I'm going to raise money for it. You know what I mean? I love my investors and I don't regret raising money for Forecastr, but it is a big process and it's a big responsibility. And then other people are in there, with you. So, to Ryan's point, it's just, unless you need to, and unless the opportunity is such that you need to raise money, I would recommend you just don't.
Yeah, I guess the caveat there are some business models that even though you might be able to survive for another year, they require the kinds of capital to get off the ground that fundraising necessitates. So it's like, oh, like, yeah, I could run this business for another year just with my own savings, but I need millions of users. I need, huge heavy hitting kind of resources, like I'm training an open AI model or something like that, that still necessitates it, even though it doesn't seem like last resort, but it's really just where your business model is, what it's going to take it to get it to the area it needs to be to really determine that. I think it's the market's cooling. We're coming off of a bit of a mania where people raise funds for anything, but it's still a worthwhile question to ask. I got an awesome question for you, Logan, and you just highlighted a little bit. Darren asks, AI is now facilitating the move from individual and specific expertise to generalist skills. What is Forecastr doing to stay ahead of the curve in this regard?
I love that question. Yeah, I get that actually a lot. Is like basically, well, there's a couple of things there. There's how are we going to compete with AI, and then there's how are we going to leverage AI in order to step up our business. I'm personally not in any way, shape, or form afraid of AI when it comes to financial modeling, when it comes to content, when it comes to social things, when it comes to like all of that good stuff. That I think is going to take a lot of jobs. I think AI can be very, very helpful whenever it comes to financial planning and analysis. I don't see ChatGPT spitting out a custom-built financial model for your company, keeping it up to date every month, and then reporting to your investors and making real-time adjustments. I just don't. I don't see that happening anytime in real time. But what I do see is us using AI in order to enhance our own software. And that is something that we're looking into right now, is looking at the output of the data, making real-time recommendations and kind of like doing that. So basically using it as a bolt-on to the model to help you run your business better. There's actually already some cool tools out there that we've talked to the founders of that use that to analyze financial statements. So I think there is a future of AI in Forecastr. It's somewhat unclear as to what that is at this point in time, but we are looking at it. But no, I don't see AI taking the company away from us anytime soon. Yeah, that's my answer. I do really want to answer the second one, or I really want to get your answer too, Ryan. How important is an NDA during the presentation to investors? Yeah, exactly.
It'll kill you.
But do not ask for an investor to sign an NDA. They will not meet with you, and they will probably joke about you behind your back. That's the unfortunate answer. The reason for that is because investors, their entire jobs are meeting with founders, and they're going to meet with people that are going to be competing with you. They just are. If they sign an NDA, they're putting themselves on legal risk, and so they just won't do it. They'll just say, "I'm not going to take that meeting. That's just a bad idea." So do not ask for them to sign an NDA. They won't do it, and it's just going to halt your process. And you
it will show a naivete about the founder and their experience in the space, which is not the end of the world, depending on the kind of investor, but it definitely is an early red flag. Beyond the practicalities of just their job, being looking at hundreds of companies. I mean, the average angel invests in one company a year, and that's an active angel. Angels go up and down through activity a lot too, depending on the rest of their lives. So they have to look at thousands of companies before they consider writing a check. So there's the practicalities of like putting legal frameworks around that is, it would make their life a mess. It'd make it impossible. But then there's the realities of the space too, outside of contract law, which is execution is 90% of the worth here. Your idea is dark as this is to say, is almost worthless. It's a multiplier on the execution that goes behind it for sure. There are some really massive ideas and founders who think super long-term, but to think that you are the only person that conceptualized the thing that the businesses that you want to start is ridiculous. There's billions of people on this planet. There's tons of people, I mean, Gus Launch probably has 20 competitors now. Clearly we weren't the only ones to do it. And also everybody copies. So like as soon as an idea is out there, somebody does it in a different market or whatnot. The realities of fundraising and company success has so little to do with the idea and so much to do with the execution. And that's what investors look for. So the idea, I think the biggest fear that founders think is like, my idea is so unique. If I pitch it to an investor, I'm under-resourced. They're just going to go and find 5 crack programmers and an ex-CEO that they used to invest in, and they'll just take my idea, carbon copy, footprint it, and grow a venture-backed company and just steal it from me. Like all my values in the idea, it's just not practical. Like literally read every single business success story. Well, read them from primary sources that you trust, because a lot of times the success kind of paves over the past and how things actually happened. But the vast majority of, I would almost say almost all companies didn't come off of like, oh, the idea was great, so they deserve the funding. So it's not a thing to worry about.
And just one more thing to tack onto that. If you even just think about my ideas, everything, think of how fragile that is, right? Think if I'm an investor, really, like if somebody else hears about your idea, you're dead in the water, so you need me to sign this piece of paper. Like that is, you should be confident and be like, here, take my idea. I don't care. Watch me. I'm going to destroy this. I can beat this. I can beat everybody else out here. I don't care if you hear my idea. Just watch me go. You know what I mean? That type of thing. So, ideas, borderline worthless, execution's everything.
Yep. Oh, I will say there is one reason to sign an NDA. And that is if your company is, and it's not upfront. It's never for a pitch. It's never even for the second pitch or probably the third pitch or even maybe the financial model review. If your company hinges on proprietary, patented, crazy information or something like that, like you just sequenced a genome that leveraged into AI to, I don't know, make a robotic cheetah. Like if a core part of the investment hinges on the technology actually working, and it seems infeasible that the technology works, this is what you've done. At some point, when you share the actual specs, when you share the actual trade secrets with potentially your lead investor, when you're way, 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 way down the relationship pipe where other than fraud or you lying, investment is kind of imminent, then those things might be relevant. But that is not a pitch NDA. That is I'm sharing trade secrets with an individual, for a business transaction. It makes more sense. And the investor at that point is not like, oh man, I have to manage this with the thousands of other NDAs I signed with thousands of other companies. Like that's a non-material issue at that point.
There's only one other reason that you should do it, and that is if you have a high-profile celebrity as a co-founder that doesn't want it out yet. That's the only other time.
That's a good one. Yeah. If anybody there is like that in this audience, they probably, I don't know why you're at this webinar, but.
Right.
We got one for you. Lunid Lewis this is technical forecaster. Is it month to month? What's the term? How does the subscription work?
So it is month to month. There is a small term 4-month commitment. The only reason that we hold you to a 4-month commitment is that gives us enough time to build your model, make sure it's operationalized, and deliver the first report. That's us showing our full value. So if after you get that and you're like, nah, it's not for me, we'll let you leave. That's kind of the idea there. And then I see the question for Jimmy. Whose picture are you using? Beard? No, that's Jimmy in the picture. If you can't tell, that's him with the beard. So no, I'm just kidding. That is our director of marketing, Michael Ford, using his Zoom account. So
sharing Zoom's expensive if you have to add every odd person.
Yes, it is.
That is amazing. I think we only have one left unless you had something, Logan.
Nope, I don't. I see it too. Do we have any luck with cold outreach to investors? No. We have never had an investor that has invested in the company that we did a cold outreach to. I have had luck with cold outreach in other aspects, aka Gust, which is one of our, in some ways you can kind of even count them as an investor since they send us so much revenue. But generally, no, I've never really had any luck with cold. But you can get pretty close to cold if you have a very weak connection with people. And I have gotten some very stretched connections. and gotten investment through some folks that way, but generally, no, warm's the name of the game.
And a slight twist on that I would say is cold outreach to a random person with a random email. That's like the definition of cold outreach. And there's reasons why, there's a lot of noise out there. There's probably going to be even more noise now that anybody can write an email that seems remotely professional through whatever. If you're at the position where cold outreach seems like you're only, your network's just not big enough, you don't have enough experience, you come from a background that you just don't have an uncle that is connected to an angel investor. There's organizations out there that can really help change cold outreach to like more of an application. So angel groups are a great example of it, where you don't need to know the investors at the angel group. You don't need there's a referred by for sure, but like angel groups run a process. Most of them are a monthly process where they'll take in a couple hundred applications. A committee will screen them and they will select, some people, and they will reach back out and say, hey, come pitch. Even if you're a stranger to everybody in this room, we want to hear your pitch because you put together a good financial model. You put together a decent profile. Like, this is kind of interesting. Accelerators are another great thing. They'll take in 100 applications and they'll pick small amounts. So there are options out there that might give you a bit more. It's still a numbers game. Like most of these things, invest in dozens of companies. Accelerators take, single digit amounts of founders for each cohort. So it's not a guaranteed thing, but it can often be a better expenditure of time than just like guessing at first name at email addresses and like shooting things to, random investors that, might not ever return to you.
Big time, big time. I think that's everything. Yeah, I don't see anything else in the chat. So I'll let you close this out, Ryan, but I just want to say thank you all for sticking with us. I see a lot of people are still participating, even though we're seven minutes past. So I appreciate y'all sticking with us. And hopefully you learned something. This is a new series that we're really excited about. So we're excited to do part 2 and part 3 as well.
Yeah, so be on the lookout for invites for me for those. This is great. This is a ton of fun, Logan. What I really like is we did not rehearse or script this at all, but like our worldviews are very aligned, which for those in the audience, hopefully will give you some credibility that we're coming from very different backgrounds, but experiencing the same things and, divulging the same kind of learnings from existing in the space. There's 2 more events in this series. I think they're coming out just within the next month or weeks or so. They'll all be part of the scale curriculum. So look out for more stuff from them, Forecastr and the team. And we also do some other fun stuff with the team. We'll send a follow-up with the recording with links to all the great stuff that Jimmy has shared in the chat, so you can just get that discount if Forecastr makes sense with you. And have a great week, everybody.
Thank
you, Logan. Thank you, Jimmy.
See you, everybody.